everyone. I'm Carrie Delgott, Wescott's Chief Operating Officer, and I'm here with Mark McCarron, Wescott's Chief Investment Officer. Great to see you, Mark.
Good to see you, Carrie.
Mark, today's topic is focused on the case for non-U.S. investments. So to set the stage, U.S. stocks have dominated for more than a decade now. Since the financial crisis of 2009, domestic equities have returned an average of 13% per year, compared to 6% per year for global equities. In addition to the record low interest rates, valuations are at an all-time high, which is bolstered by the tech-heavy U.S. markets that have greatly benefited from the shift to e-commerce. As we head into the second half of the year, many are asking if the U.S. equity markets have hit a peak. What are your thoughts?
Great question. It's been a very strong period of time for the U.S. As you mentioned, the last decade has been dominated by U.S. assets, whether it's the stock market, the bond market, or the currency market. We'll talk about the U.S. dollar in a moment. And you're right. I mean, the fact is, the questions are coming. How much more can the U.S. Market go up? Are we at a peak? These are great questions that we ask ourselves all the time on the investment committee. I think it's important to put this last decade into some context, though, because the decade prior, from 2000 to 2009, it was considered sort of a lost decade for the United States. So it was a period of time where there were two recessions. The stock market, the S&P 500, returned close to 0% on an annualized basis over 10 years. So that was clearly an area of weakness. And in fact, a lot of investors looked outside the U.S. at that point to find return, to find growth, and to find opportunity. And so valuation is a question we get asked a lot. So just a quick update here. Where we are today, at least at the end of the first quarter officially, was a valuation of 21 times forward earnings. So it's basically how much do you have to pay for next year's earnings? And 21 times is much higher than the 25-year average of 16 times. And that's an indication that, things are expensive and they're priced for perfection. That's a forward-looking estimate. If you look backward using another valuation technique called the Shiller's PE, which is basically today's price, but last 10 years of earnings, it's also expensive. 35, nearly 36 times that on that measure versus 27 over the last 25 years. So I don't think we can hide from the fact that the U.S. market is expensive. Has it reached its peak? Really hard to tell, but it's not cheap anymore.
And in addition to an expensive U.S. market, the relative strength of the dollar compared to other currencies is an interesting point of discussion. Would you expand on not only the opportunity, but the impact that the expected global growth would have on the dollar?
Yeah, the dollar doesn't get as much attention perhaps as the U.S. stock market does, but if you look at the strength in the U.S. dollar against other major currencies, we have it graphed here. This is the trade-weighted dollar. What that means is basically what is the dollar valued at? If you look at its trading partners' currency, over the last 10 years, it's gone up and up and up, really since 2011. And why is that? There's a lot of reasons for that, but as the market has been strong, the stock market's been strong, foreign investors have poured money into the U.S. market. If inflation were to pick up, if there become a concern on debt to GDP, which is a factor and a feature of the current environment in the U.S., and if growth picks up outside the U.S. faster than the U.S., then those same foreign and global investors may look outside the U.S. for investment opportunity, selling the dollar. And we're beginning to see that weakness the last several months as the non-U.S. markets begin to catch up and grow and show an opportunity. And we'll talk about this again. The valuation of those non-U.S. markets are relatively attractive compared to the U.S., which is trading at premium levels.
So you're starting to talk to us about opportunities. Can you expand on the risks and opportunities for both the US and non-US market environment, and is now a good time to turn our attention more towards the high growth forecasts and low valuations that are available in the international markets?
Yeah, I think it is a good time. There are a lot of headwinds that are coming through in the US market. The first and foremost is the question we're getting from a lot of clients is what's the impact of inflation in the US? And we're beginning to see a pickup there. So rising US inflation is a headwind for US assets, including stocks and bonds. There may be more regulation coming through, trying to manage the dominance of technology in the United States, which, by the way, has been the leading sector moving the stock market in the US to its all-time high. Tax rates may also go up from where they are today, adding another headwind. And we talked about the dollar weakness. That could be an issue too. And finally, interest rates that might go up in concert with higher inflation will also have a potential impact on the valuation story in the US. So combining all that with the fact that the vaccine deployment outside the US is ramping up faster now, economic growth seems to be recovering now, both in Europe and in Asia, and those markets are relatively cheap compared to the US, might mean it's a good time to start thinking about non-US markets. So let's cover a little bit of those topics in more detail. The first, we've already talked about the dominance of the US stock market. In this chart, we're showing periods of time where the US outperforms the non-US markets. So the US is in gray, non-US markets, as represented by MSCI EAFE index, which is a common index, shows that this period of performance in one region versus the other tends to be relatively cyclical. Now, it's not always the same time frame, but the last 13 years, the stock market in the US has outperformed non-US markets by 217%. That is a pretty amazing number. And the last time it was really at this level was at the end of the 1990s. And once the technology bubble burst in 1999, non-US stocks, along with small cap and value stocks, by the way, started to become in favor. And the outperformance, if you will, of non-US markets versus US markets was pretty strong at 64%, and it lasted 7 years. So it's always hard to time these things, but one thing might drive that timing is valuation. And I get questions a lot, isn't the non-US market always trading at a discount to the US? And the answer is yes to that. So we're using a chart here. This is by JP Morgan. If we look at the average discount that non-US markets trade relative to the US in terms of valuation, it's 12% discount, meaning it's cheaper by about 12% almost all the time. What we're finding, though, is that today's valuation is 25 times cheaper, 25% cheaper, not 25 times, to be clear. So a much more opportunity, much more significant discount, if you will, to the US market today, which means that if you combine that with a pickup in economic growth, and that we're seeing evidence of that economic growth pick up both in the European markets and in the Asian markets, this may be an interesting time to consider, given the headwinds in the US, the allocations that you have in the portfolios in international markets.
Terrific. And I'm sure that our clients are pretty interested in knowing what type of international and even emerging market exposure we have in our Wescott portfolios. So why don't you close us out today with a bit of an overview?
Yeah, I think it's important. We do often talk about the US and how we're positioned, but the chart on the left shows the allocations we have to the specialist managers in both the developed markets and the emerging markets. And that mix is reviewed on a regular basis by the investment committee to ensure that we're balanced the right way. One thing I would highlight on the top right chart is that our third largest position after Japan and the UK is China, so an emerging market. And in fact, if you look at that position one level lower, Tencent Holdings is our largest international exposure. And Tencent is a Chinese-based conglomerate that does everything from social media to gaming to payment systems, you name it, they do it, and they dominate that outside the U.S., but in China specifically. Taiwan Semiconductor and Samsung Electronics round out the top three. Again, three dominant players in Asia that represent big positions for Wescott clients outside the U.S. In addition to that, we have exposure across Europe with Sanofi and LVMH, Novartis. These are well-known, big global brands that are valuable and are maybe being ignored relative to the Apple and the Google and the Amazon that have dominated headlines, but also dominated the U.S. stock market for the last 10 years. So there is opportunity outside the U.S., we think, and it's a good time to start thinking about and evaluating where those opportunities might be.
Thanks, Mark. You've continued to remind us that the market rotation will favor not only value stocks, but also the broad global market as the global recovery continues. This is a great update. As always, please don't hesitate to reach out to Mark or your advisor with any questions, and thank you for your trust in Wescott.